demigod of MEC, Mortgage Educators and Compliance. David, thank you very much for being here.
I don't know about that demigod comment, but real quick question. As we're looking at interest rates, appreciation, inventory, economy, as we're looking at all those kinds of things, how much of those things are of interest to you guys? What's going to happen? What's happening with inventory, sales, appreciation? Right? How many of those things are important to you? All of them. Okay. So here we have Chairman Powell that says we need to see inflation coming down in a clear and convincing way. We're going to keep pushing until we see that. Notice the dates on all of these things. The dates on all of these things are about as current as I can make them. And so how much do we think the Fed is going to raise the Fed funds rate? We'll talk about all of that. From the Federal Reserve Bank of Dallas, they said, you know what, we think we're in a housing bubble. Quick question for you guys. Are we in a housing bubble, yes or no? No, we're not. No, we're not. Why are we not? We don't have enough inventory. So let me take you back down memory lane. In 2017, 2018, interest rates rose from the high 3s to about 5. Wait a minute, that kind of sounds like now. Okay, payments got more expensive. It didn't result in a housing bubble. In fact, the median house price rose from $299 to $319. We're not in a housing bubble. We're watching to see what interest rates are doing. About a year ago, we saw that the interest rates were high 2s, low 3s, and now we're seeing around 5.1. We were teased last week when we saw interest rates kind of dip down. Has anybody seen what rates are doing today? What are they doing? They're up. Guys, that's going to be our reality for the next little bit. Notice I didn't say a year. Folks, interest rates will drop. And they will drop significantly. Let me show you why. I want to take you in history as to what happened in 2008 and 2010. Do you guys remember the housing bubble? Do you guys remember when builders were really building stuff? Do you guys remember all of that? Say yes? Okay. So they got burned so bad that they said, you know what, we're not going to build the homes that we used to. That's why inventory has been so low for so long. Another thing you need to understand, when building slows when interest rates go above 5%. Where's interest rates today? 5%. So what you're going to see is you're going to see builders start to slow down. But Dave, we need more inventory. I understand that. But they also want to sell the homes that they build. Now, notice the dates on everything that I'm sending you guys. Everything that I'm sending you guys is current, right? So from Fannie, they're saying, oh my goodness, we've seen a whole bunch of appreciation. Would you guys agree that we in the housing industry have seen a ton of appreciation? Say yes. Yes. Over the last 41 quarters. Over the last 41 quarters, we have seen appreciation only go in one direction, and that's up. So from the National Association of Home Builders, they kick out a report that they call the Housing Market Index. So I want you to direct your attention to the right-hand side of the screen, and I want you to notice the trend. As we're looking at the trend from January, you see it at a high of, in the 80s, February, not too bad, March, now we're in the 70s, April, we're in the lower 70s, May, we just finished May. What do you think the builder sentiment is out there? Louder, I can't hear you. Don't make me call volunteers. How do you think builders are feeling? Are they feeling positive about, lumber prices and glass and windows and drywall and getting laborers out there and building homes, or do you think they're feeling a little less confident? Less confident. So you're not necessarily going to see a whole lot of additional inventory. We need jobs. They're hiring tens of thousands of people every single month. But the Home Builders Institute says that we need 740,000 residential construction workers every year. And over the next 3 years, they're sitting there saying, man, if we could just get 300,000 positions a month, that would be great. Okay, so from our administration, they rolled out a program, May 16th. The May 16th program is the Housing Supply Action Plan. And I think it's a great idea, except their plan is to put 125,000 new homes or affordable homes into the system over the next 3 years. Ladies and gentlemen, we need 1.7 million new homes per year. 125,000 over 3 to 5 years, do you think that's going to make a dent? No, not going to make a dent. So I have no idea who the funny looking guy is with the tan. He is an ugly man, at least his wife loves him. Homeownership vacancy rate, 0.9, the lowest since 1956. Inventory is the lowest in over 20 years. New inventory, now existing homes versus new homes, at the lowest level since 1973. We really need to be looking at this next gen of folks coming in. The millennial, you have 4.8 million that will be turning 33 years of age over the next 3 years. That's 32 million of these people that don't want to live with mom and dad, that have already finished their schooling, they want to get a house, and they're talking to their friends who did buy a home, and they're sitting there saying, oh my goodness, your home is appreciated. What? Because all they're doing is throwing money out the window. What do these people need? In one word, look at the top of the screen, education. Guys, answer the question for me. What do these first-time home buyers think they need as a down payment? 20%. You are the keepers of knowledge. You need to share with them that it doesn't have to be 20%, but they still don't know what their credit score needs to be. They don't know what their DTI needs to be. They don't know. So looking at vacancy rates, look at the right-hand side of that graph. You see how that thing is like falling off a cliff, right? If they're not going to live with mom and dad, yet they can't afford something, what are they going to do? They're going to rent. Folks, the average rent, you guys are going to laugh, but this is nationwide figures, is $18.77. You guys are laughing because you're like, oh my goodness, I wish I could find something for $18.77, right? The report is based off of 20,000 apartment buildings across the U.S. Look at the bottom line. The top 10 metro areas, rents are up 29%. You think a 5% interest rate is really going to mess these people up? Oh, no. They're already used to their housing expenses going up big time. Last year, 446,000 apartments were built. That's the most since 1990. And inventory issues will not be solved for years. What does that mean? That means your homes, the ones that you own right now, your appreciation, as far as my crystal ball can see, and I did change from batteries to USB, so I charged my crystal ball up this morning. Guys, for the next 3 to 4 years, appreciation is only going to go in one direction. What is it? That's it. Okay? People still need somewhere to live. So we talk about things like Consumer Price Index, the CPI. 40% of the CPI is because of rents. That's why the CPI looks so high, right? You get housing under control, everything else will fall under control as well. We have to talk about COVID-19, and I'm glad we are now able to remove face masks and get together. But this thing didn't just influence restaurant and hospitality individuals, but also shipping and construction. We should start to see supply chain issues loosen as prices start to stabilize. Now, let's look at this. This is from the New York Times. I needed to get the presentation so it could be loaded on. May 30th, 2022. How old is this? A couple days. How many new cases came out? Right-hand side, look at it. Zero. Are we getting a handle on COVID? The answer is yes. So we've had 2 million jobs created so far. We don't have the numbers for this previous month ended May. My estimation, again, hundreds of thousands. That's another reason for the general upward spike in interest rates. Now, from Michael, okay, who's the chief economist for MBA, he continues to expect that the Federal Reserve will move rates up expeditiously to counter surging inflation. So, instead of listening to MBA, from Chairman Powell, said there is a broad sense on the committee that an additional 50 basis point increase should be on the table for the next couple of meetings. Now they're meeting in 2 weeks. What do you guys think the Federal Reserve is going to do? They're going to raise rates by how much? 50 basis points. What about the meeting after that? Another 50. Because they're sitting there thinking we need to raise this to start to rein in inflation. Now, one of the variables that we can't really, let me go back. How do I go back? This is not my remote. By the way, my presentation is much more colorful instead of all this white. So this is what it looks like when you hand it over to somebody else. Anyway, because of the war going on with Russia and Ukraine, that's the variable that we can't really put our fingers on. I mean, how long will it be before we get some sort of normalcy in what's going on? That's a variable that's a variable nobody can put their fingers on as to what the heck is going to happen. So we're doing everything other than what's going to happen with the war. By the way, if you know what the heck's going to happen, please let me know. Higher price homes are the only winner right now. Lower price homes, that's not happening. So we asked the National Association of Home Builders, why is it so stinking hard to get an entry level or an affordable home? Would you guys agree that we have a lack of inventory? Yes. Would you guys agree that we have a lack of affordable housing? Yes. Okay. So when we asked the question, they came back and they said, Dave, it's regulations. Whether it's a county level, whether it's a state level, whether it's a city level, they're saying regulations is zinging us almost $100,000 before we start. So some of you guys are not in California. Some of you guys are in another state. So let's look at the University of Arizona. See, it's all white across the top, and you guys can't see it. So this is Mark's staff. And he says in his Arizona example, which I thought was an okay example, $875,000 is the home. The lot, $219,000. $11,000 for financing, $49,000 for an open house, $28,000 towards commission, $307,000. Let's go backwards. Plus this. Guys, we haven't talked about the materials. We haven't talked about labor. We haven't talked about anything else to build the house. And so because we haven't even touched on that, that's why builders can't build an affordable house right now. So you had 10,000 sign a letter to President Biden saying, you know what? You're asking us to help move this economy along, but we are, quote, at an inflection point that threatens to derail the current housing and economic expansion. We are the only part right now in the economy that's moving things forward. Now, lumber prices, this is pretty current, but when we start seeing supply chain issues resolved, let me see if I can get my laser here, ready? So we know April of 2020, it was about $400 for 1,000 linear board feet, and then it went up to about $1,800. You guys can see the graph going back and forth. So let's look about 2 months ago. 2 months ago, it was pretty pricey. But as of right now, it's about $660. When they shut down a sawmill, it costs hundreds of millions of dollars to restart those up. So the solid market for home building continued despite ongoing supply side challenges, said the National Association of Home Builder Chairman. Lack of resale inventory combined with strong consumer demand continues to boost single-family home building. Okay, so we need about 5 million. Whoa, screwed up on that one. Let's try it again. There we go. All right, we need about 5 million new homes, total. We need about 1.7 per year. If we don't get that, guys, your homes will continue to increase in value. Again, I apologize for the presentation. It's much more colorful. Some of the stuff is in white, but it got whitewashed out. Sometimes as I'm going around the country visiting with you guys, you're saying, Dave, you have private investors, Goldman Sachs, that are just buying things so the individual can't buy them. Folks, that's not true. That's not true. Oh, but Dave, I saw the New York Post. Guys, did you read it? Okay. Goldman Sachs bought an entire Florida community for $45 million. Do the math. If you split out the pricing of the home, that equates to 87. That's 87 houses. We need 1.7 million. You think 87 houses is going to make a dent? No. So if you go to action.com, action.com accounted for more than 40% of all foreclosure sales nationwide in the last 2 years. They are reporting less than 1% of action.com buyers purchase more than 10 foreclosed auction properties. No, Right now, because of appreciation, you don't have these institutional investors out there that are buying up all of these tracts of houses. Guys, that's just not real. So I gave you the data, and you needed to take and understand the data so I can tell you what's going to happen next. Does anybody want to know what's going to happen over the next 6 months? Yes. Say yes. Yes. Louder. Yes. Okay. So this is April 22nd. Buyers actively engaged in finding a home in the first quarter of 22. If they spend 3 or more months looking, they stop looking. Why? They can't qualify anymore, but guys, first-time home buyers, you heard some speakers earlier. They're looking at Pinterest and they're sitting there saying, well, you know what? I'd like to have the swimming pool, I'd like to have the secret garden, and I want to have the sauna, and I'd like to have 7 bedrooms and 4 bathrooms, and I really don't want to pay more than $350,000. Well, wait a minute. What's happening is we're now setting expectations of if that's what you want, you're going to be looking at $2.8 to $3.2 million. Oh, I can't afford that. Oh, well then maybe you better look at something more realistic. Again, I have no idea who the funny looking guy is, but he's sitting there saying home prices should begin to slow their rise and stabilize in some markets. And home prices should start to drop. Dave, I don't know what the heck you're drinking, but that's not water. That's like alcohol or something. Well, Freddie is also saying the same thing from their chief economist as well. Redfin. The number of home sellers who dropped their asking price shot up to a 6-month high of 15%, okay, during a 4-week period ending on May 1. What? Yep. Sellers that are used to these sky-high prices, well, my home is worth $1.5 million, so I think I'll list it for 2. No. Well, I'll list it for 1.8, then I'll have multiple offers. No, that's not reality right now. We have seen 41 straight quarters of increases since 2012. It has only gone up. And so we need to reset expectations where these guys are, hey, if the house is worth 1.5, list it for 1.5, you'll sell it for 1.5. You want to list it at 1.8 and expect 20 or 30 offers, that's not today's market. That's definitely not going to be the future market. Redfin. Many sellers are still seeking sky-high prices for their homes, even though rising rates have limited homebuyer budgets. As demand continues to soften, more sellers will likely be forced to drop their prices in order to get offers accepted. So, according to Realtor.com, where are home prices falling the most? Because we're in Southern California, look at, number 7. Where's number 7 on that list? Guys, that's not me, that's Realtor.com. As well as other places around the country, home prices are starting to soften and home prices are going down. Things today are different than what they were 2 months ago. 2 months ago, you had inventory of 2 months. Today, you have inventory of 9 months. And again, I'm showing you that it isn't me telling you these things, right? I'm showing you where Redfin and Realtor.com and Freddie and everybody else is talking so that you can see the National Association of Home Builders, the National Association of Realtors. I'm trying to give you, do you guys think that this information is important? If you get it, it'll be much more colorful. How many of you guys want to have this to maybe share with your realtor partners or other referral partners? Heck, maybe share with barbers. Do you guys like this? Yes. Okay, cool. Should we continue? Yes. Oh my goodness. Okay, cool. So Dr. Lawrence Yun, chief economist for NAR, said the dip in contract signings, quote, multiple offers will soon dissipate and be replaced by much calmer and normalized market conditions. We cannot sustain how aggressive appreciation has been. It has been absolutely, radically nuts. It needs to calm down. Rates need to go down. Oh, but Dave, the Federal Reserve is raising rates. Okay. We'll talk about that. The central bank will allow its holdings to get smaller. They're going to buy less, all right? Starting June 1, and I don't know why this PowerPoint thing kind of messes things up. But anyway, the data will look much better when I send it to you. Anyway, when the Fed raise rates, you should be extremely pleased. Dave, what? I'm serious. Whenever the Fed raises the Fed funds rate, what happens to long-term mortgage interest rates shortly thereafter? They go down. So right now, supply chain constraints and oil and gas is what's doing the inflation, all right? So let's look at other folks. Janet Yellen, quote, inflation may have peaked in the U.S. Dave, what? It's not going to go up any higher, okay? But caution that prices may remain elevated for a while longer. Dr. Elliot Eisenberg, year over year, CPI inflation eased, not a lot, to 8.3 from 8.5, the first decline since 2021. Inflation is probably peaked. Now you got two super smart people that have told you that. But the rise in core suggests inflation will not decline quickly. So folks, we're not over yet. You're gonna have, excuse my French, months before things get better. It will not be in quarter 2, it will not be in quarter 3. However, in the fourth quarter of this year, oh baby, is it going to be fun. It is going to be really, really good. May 17th, we're raising rates expeditiously to what we have been seeing as a normal level, which is something that we will reach maybe in the fourth quarter. Dave said it, and I'm nobody, but Chairman Powell said it, fourth quarter. Okay. So they're meeting here in June, and in June they're going to raise it by 50 basis points. So when the Fed raises the Fed funds rate, what does that mean? It means it's going to be higher prices for credit cards, for automobile loans, for home equity lines of credit. When the Fed raises those, it helps longer-term interest rates like mortgages. All of this is disinflationary. And what that means is, oh my goodness, is that wow. C2, I love you, but you need to upgrade your PowerPoint. Okay, stop, guys, I can do this. I don't even have to look at the slides, I can do this. Ready? Guys, from 2004 to 2006, the Fed raised interest rate 17 times. They took it from 1 to 5%. What happened to mortgage rates at the end of 17 times the Fed raising rates? What happened? Long-term mortgage rates dropped. And I hope this one turns out. Wow. Okay, stop. I'll think I'm a professional. I can do this. So from 80 to 87, right, interest rates were cruising somewhere in the neighborhood of 18%. I mean, when I started back in 1980, interest rates were at 17%. The first refi I did, the guy was so thrilled. It was here in LA. He says, Dave, never did I think interest rates would get all the way down to 16. And I'm sitting there thinking, yeah, me neither. Anyway, the Fed funds rate went up. Wow. It went up from 11% to 20%, and interest rates went down from 18 and 16 down to 12. Whether it's Chairman Volcker, Alan Greenspan, guys, it doesn't matter who it was, Ben Bernanke, it doesn't matter. It always is the same case, that whenever the Fed funds rate goes up, mortgage rates go down. This one's a little weird because that was that Great Recession thing going on. And so right now, they're trying to raise interest rates. They're guessing that it's going to be somewhere in the neighborhood of 1.75 to maybe 3.25. What do you think will happen with rates if they do that? They'll drop. Absolutely they will. Absolutely they will. So, all right, you're gonna have to imagine this. So up at the top, you hear these terms, recession, right? Are we gonna have a recession? The answer is yes. But there's a couple of things that need to happen first. So are we gonna have like a recession soon? Well, here's some indicators. One, when the Fed raises the Fed funds rate, okay, that's an indicator. When the 2-year and the 10-year invert, does everybody know what I mean by that? When they invert? Okay, so you get paid a better interest rate for a shorter term, 2 years, than a longer term. We tie up your money for 10 years, we'll pay you less than if you give us your money for 2 years. When they invert, that's another indicator that we may have a recession coming. Also, the Conference Board of Leading Economic Index, it typically falls 4 to 6 months before a recession. Guess what? No problem there. No problem there. When unemployment gets to 4% or below, shoot, we've got that one. If construction slows, well, remember, if interest rates go above 5% and they can't find workers, and now you have less people buying houses, what do you think about that one? Do you think that's an indicator yet? Yes or no? Yes. Yeah. So we are getting very, very close to a recession, but not necessarily today. Mark Fleming, chief economist for First American. This is important. Well, Dave, will my home price drop? No. It just won't appreciate as fast as it's been in the past. Okay? So again, these sellers that are asking for the sky-high prices, they're not going to get them. There's just multiple offers. There's multiple options out there. There's multiple choices that consumers have. You heard from individuals up here before that are sitting there saying, do a rental loan, do something else. There's a lot of options out there. And so I really, really, really don't see prices falling. I see that seller expectation becoming more in line. Take out your phones, take a picture of the QR code and say, get a hold of me. If you guys want to have questions or pick my brain or whatever. Did I do that too fast? Did I do it too fast? My bad. Come on. Go back. There we go.
5 minutes.
Well, this is what I want to do, Jay. After they take their pictures. Everybody done?
We're not having, and also the pressure for the cost of energy was reduced as well. Right now we have a situation where the cost of energy is not going to come down anytime soon.
You are absolutely right on.
And we also have a situation where the current administration is looking to increase taxes, corporate and personal income taxes, which is potentially going to create a stagflation effect and is then going to increase interest rates. Do you really think that by December of this year we're going to see a decrease in mortgage rates?
Absolutely. Sir, you are correct. That when we changed in oil production, we've lost 3 million barrels, a day of production that we will never get back. And so, earlier this week, you had the European Union kind of get together, okay, what are we going to do to stop, Russian oil from moving into the EU? I think what's going to happen is it's going to increase the options of doing something other than fossil fuels, whether it's wind, whether it's solar, whether we're migrating a little bit more to electrical. I mean, look at vehicles, et cetera. And so, I think Russia, excuse my French, I think Russia shot themselves in the foot. I really, really do. Who has a question?
No more questions.
Jay, I don't know. Jay, what? No more?
No more questions.
No more questions, guys.
No more questions.
You need to go back and talk to David personally. Go to David's education seminars, and then you can talk to David.
That's right. So for